So after years of my credit score going up and down, I pretty much figured out exactly how to get an 800 credit score, and more importantly, how to keep it there. Having a score like that helps me get approved for some of the top credit cards with the best rewards, qualify for the lowest available rates on mortgages and other loans, and even landlords, employers, and insurance companies all like to see that I've got a great score. So in this video, I want to talk about the 5 things that I wish I knew sooner for how to dramatically increase your credit score up to and around that coveted 800 level, starting with the golden rule for how to actually pay your credit cards and loans. Now, a lot of people seem to get tripped up whenever it comes to paying off the credit cards in particular, just because each month you're going to receive a statement in your account like this one right here, and you're going to see terms like minimum payment due, new balance or statement balance, as well as payment due date. However, when you go back into your credit card account dashboard, you're going to see some similar terms, but then you're also going to see things like your current balance, which might or might not be a completely different number than your statement balance. For some reason, I used to get confused about the connection between all these terms, and I know a lot of other beginners out there feel the same way, but what really had me worried wasn't that it was just super complex, but it had more to do with the fact that I knew that credit card debt was just a really bad thing, and so I didn't want to accidentally fall into it by paying off my credit card the wrong way. So up until about age 22, I typically just played it safe and used a debit card for all my spending, but by doing that, I was actually opening myself up to more risk because my debit card info could have been stolen along with the money inside of my checking account. Plus, I wasn't earning any rewards and I wasn't building any credit like I should have been if I just understood the golden rule about paying off your credit card. What that rule says is that you should always pay off your statement balance on time and in full by the payment due date every single month. And eventually, once I learned that rule through some trial and error, I just realized that following it basically guarantees that I'll avoid high interest credit card debt while also increasing my credit score. It avoids high interest debt because by paying the statement balance instead of only the minimum payment, what that means is that in the credit card issuer's eyes, no balance is going to be carried over to the next statement period, and therefore no interest is going to start accruing. And it increases your credit score because by paying on time by the payment due date, that is going to positively affect what's called your payment history. Payment history is actually the highest impact factor that accounts for around 35% of your FICO score, and you want that payment history to be at 100% if possible, because anything less is really going to start to hurt your credit score. Missing one payment is bad, but missing 2 payments is worse, and then so on. And even a single missed payment is going to stay on your credit report for 7 years, keeping your score lower than it would be otherwise. So this is stuff that you definitely do not want to forget about. Now, in a worst case scenario that you don't make a payment by the due date 1 month, then don't panic. And that's because with most lenders, they are not going to report that missed payment over to the credit bureaus until after 30 days have passed. So if you realize that you forgot to pay your statement balance, then just go ahead and do that ASAP before those 30 days go on. To show you guys how that works, back over on my credit card statement as an example here, we can see that this statement is for the billing period from November 29th until December 27th. And then over on the account summary, my issuer tells me that my previous balance was paid in full, and then I made $86.54 in purchases during this billing period, so my new balance at the bottom there is $86.54. Then they restate that over there on the left by telling me that my new balance as of the last day for this billing period was $86.54. And one thing I want to mention here is that the term new balance and statement balance are going to be pretty much interchangeable. So for the golden rule of paying your statement balance on time and in full by the payment due date, in this example right here, we want to pay $86.54 by the due date of January 24th that they list over here as well. Now, as for that minimum payment of $41 above that, you can really just ignore that here because our statement balance of $86.54 is going to include that $41 amount, but the credit card issuer is kind of just hoping that some people pay the minimum instead. So that way, again, there will be a remaining balance that then gets carried over to the next statement and then starts to accrue interest. Also, back over on my account dashboard where it says current balance, don't really worry too much about that either here because your current balance is just your statement balance plus any other purchases that you make in your next billing period. So in this example, again, my billing period ended on December 27th with a statement balance of $86.54, but then after December 27th, I did make a few other purchases that count towards my next billing period, so that's why my current balance is a bit higher at $116.78. Now, that's how paying off revolving credit like a credit card works, but when it comes to most installment loans like a car loan or a mortgage, typically what's going to happen is you're going to have a set payment that you just have to make every single month until that loan is paid off. So in the case of loans like this, the minimum payment due every month is basically going to be the same thing as your statement balance. For that, if you have a car loan of maybe $300 per month, then just make sure you're always paying that $300 amount because again, any late payments are really what's going to start to hurt your credit score. And if you do want to pay more than that amount to start paying down that loan a bit faster, then you can do that, but it's not required. Now, next here, the second thing that I wish I knew about increasing your credit score is that credit utilization matters, but only sort of when I learned how it works. So here's a few tricks that you can use to essentially just manipulate your utilization and help move your credit score closer towards 800. Credit utilization is a major component of the amounts owed factor of your score, which affects around 30% of it. So if you're able to focus on managing payment history and amounts owed here, then that's already going to be covering 2/3 of your credit score. Also, I want to point out that there are different scoring models out there that might weigh things slightly differently from each other. But in general, the habits we're talking about developing here are going to be universal across all these models. So that's what I want the main takeaway from this video to be for anyone who's watching it. Now, credit utilization basically looks at the percentage of available credit that you're using on credit cards and other lines of credit. And to calculate this for a credit card, we just take whatever your statement balance is on the last day of a billing period or billing cycle, and then we take that and divide that by the credit limit on that card to get a percentage. For example, if we looked at my credit card statement from earlier here, I had a statement balance of $86.54 on the last day of my billing period, and my credit limit on that card was $6,800. So $86.54 divided by $6,800 is going to give me a credit utilization of 1.27%. Now, your credit utilization for each individual credit card is going to affect your score, but your overall credit utilization across all cards combined is also factored in here, so you want to pay attention to both those things. In my opinion, if there was a golden rule for credit utilization, which there kind of is, then it would be to keep utilization below 10%, but ideally in the low single digit range. However, it's not really such a big deal if you break that rule from time to time, and here's why. The way that most credit scoring models work is that for credit utilization and the amounts owed factor here, your credit score basically doesn't have a memory. And so what that means is that if you had a utilization of 35% from one billing period, that dropped your score, but then for the next billing period, you showed a utilization of 1%, your credit score is typically going to go right back up, and you're not going to be penalized for having a previously high utilization. I eventually learned this myself after several times where I had a higher utilization get reported one month, and then that dropped my score by like 20 or 30 points. But then once I got that utilization back up to a normal lower range the next month, my score just shot right back up. Now, there are some newer credit scoring models out there that are starting to take a look at trends with utilization, so I would still make it a habit to try to maintain a low utilization below 10% if you can, which is what I do. But I used to be so stressed about this stuff and so strict about it with always paying down each of my credit cards every single month to almost exactly 1% utilization to try to always optimize for this. Honestly, doing that was good for my score, but there's no need to be always doing that unless I'm really just trying to get my credit score in the best place possible before applying for a new credit card or a new loan. So again, my recommendation here is to get into the habit of keeping your credit utilization on all your credit cards in the low single digit range if you can, but also don't really stress about it too much, because if your utilization rises from time to time, that's sort of a natural thing. Now, like I said before, if your utilization is starting to look like it's going to be really high here and you want to make sure it does not cause a dip in your credit score, then what you can always do is just pay down your balance before the statement closing date. So back to my credit card statement as an example with a $6,800 limit. Let's say that I had to make a $4,000 purchase for some home renovations or something like that. If that $4,000 balance got reported over to the credit bureaus on my statement closing date, then that would be a 58.8% utilization, which definitely would drop my credit score in the short term until I got that lower. But if I wanted to avoid that drop in the first place, then I could just pay down maybe $3,900 before the closing date. That would leave me with a $100 statement balance, which would be a 1.47% utilization. That's very good. So again, remember, you can manipulate utilization in situations like this if you have to, but also don't stress too much about it unless you really need your credit score to be in the best shape possible very soon. Now, the next thing that I wish I knew about credit scores has to do with a factor that affects around 15% of your score, which is going to be length of credit history. And for this, I wish I knew the difference between length of credit history and credit age, because they both are going to sound very similar here, and they both impact your score under this factor, but in slightly different ways. So length of credit history is basically the amount of time that any given account on your credit report has been open. And for this, because you can't really control time, my two best pieces of advice are to start building your credit sooner rather than later. And then also never close your oldest credit card account if it's a card with no annual fee, because that oldest account is going to be helping your credit score as it gets older and older with time. One of my big mistakes was that I waited until I was 20 years old to open my first credit card, and I still have that account open today, and it's got a length of credit history of around 8.5 years, but it could be as much as 11 years if I opened it sooner. Another common mistake that I see a lot of people make here is that they open a credit card that has an annual fee as their very first credit card, and then they're just afraid to close it in the future, so they keep eating the annual fee, and it's probably not worth it anymore. There's plenty of amazing no annual fee starter credit cards, student credit cards, and other credit building cards out there that you should be looking into instead versus one with an annual fee. And I talked more about a few of these options in a previous video about how to climb the credit card ladder, so I'll go ahead and link that video down below if you want to check it out after watching this. And I'll also go ahead and link to a few of my favorite beginner credit cards down below in the description. The other big thing that gets included in the length of credit history factor of your credit score is going to be called age of credit. And this sounds similar to what we just talked about, but the main difference here with this is that with age of credit, the scoring models are going to look at how long all the accounts on your report have been opened, and then what they're going to do is calculate a single age that's the average of all those accounts. Because of this, you're going to have your oldest account battling to increase this average and keep it high as time goes on, but then also with any newer accounts you open, those obviously are going to drag down your average age of credit. For me personally, even though my oldest account is around 8.5 years old, because I'm always just opening new credit cards, my average age of credit is only a little over 3 years old, which is fine, but honestly, that's only going to keep keep getting better because most of my oldest accounts are no annual fee credit cards that I'm just gonna keep open forever. With length of credit history and age of credit, you really just have to be patient and kind of let time do its thing, as this factor impacts your ability to achieve an 800 credit score. But the good news here is that, again, those previous two factors of payment history and amounts owed are going to account for around 65% of your credit score, so those are definitely what you want to focus on the most. Now, that leads me to the fourth thing that I wish I knew sooner about credit scores, and that is going to be to remember to spread out when you open new credit accounts, because not only are those new accounts going to impact your length of credit history, but they're also going to impact another factor called new credit. Now, the new credit factor affects only around 10% of your credit score under FICO scoring models, but for the average person, I think this is probably going to be the credit score factor that you've seen affect your score the most, because it sort of happens immediately and it's pretty easy to understand why. So usually when you apply for maybe a new credit card, that credit card issuer or lender is going to run what's called a hard pull or hard inquiry, which is essentially just them kind of looking at your credit report and then reporting that they've done so. That sort of lets other lenders know that, hey, this person just recently wanted more credit, and then your credit score is going to maybe drop by just a few points to reflect that. And this new credit factor might affect you more if you have a really thin credit profile with a shorter credit history, but honestly, for most people, it's really not that big of a deal for two reasons. First, even though that hard inquiry has a small short-term impact, the impact is going to fade over the course of a year. And then after that, there's really not that much of an impact anymore until eventually that hard inquiry just fades off your credit report entirely after 2 years. Second, there's actually way more long-term positive benefits that you're going to be able to get out of that hard inquiry compared to the small short-term drop in your score. And that's because with that new account, you're now going to have the opportunity to start making more on-time payments every single month. And the new credit limit that you're going to get is going to increase your total available credit, which decreases your overall utilization with all else equal. Now, the advice with new credit that I wish I knew earlier is to spread out the time in between opening new accounts. And that's because spreading that out is really going to reduce the short-term impact of all those hard pulls while still giving you all the positive effects from the more payment history and the lower utilization. For credit cards, I usually like to recommend getting a new card every 3 to 6 months if you plan on playing the whole credit card game like me. So don't be scared of the common myth that opening new cards is going to damage your credit score, because it's not actually damaging anything here, and most people really aren't zooming out to see the full picture. Now, what credit scoring models also like to see as you're working your way up to that coveted 800 credit score is a good credit mix, because that is going to account for another 10% of your score. But my advice for the fifth thing that I wish I knew sooner about this stuff is don't really sweat your credit mix. So currently my credit mix is made up of only my credit cards and a car loan, and then within the next year or two, there's probably also going to be a mortgage in there. But never once have I ever taken on debt or opened a new credit account with the thought that, oh yeah, this is going to help improve my credit mix to get me to an 800 credit score. With some of the other factors here, I do actively think about how I can control them to get and then maintain an 800 score. But for this credit mix factor, it's really sort of just that cherry on top for helping your credit score, because you really want to live life normally. And then as you need to take advantage of different types of credit for getting an education, buying a car, buying a house, or anything else, then at those points, you could just do that, and then helping your credit score is sort of a secondary benefit. The bottom line here is that you want to focus on what you can control and what has the highest impact on your credit score, and then you want to do that consistently for years and years. There's really not any shortcut to getting an 800 credit score, and even if there was, it wouldn't really matter, because time is such a huge component in the process in making your credit profile look good to the credit bureaus and to the lenders. So if you don't have enough time in the whole game, then you're not going to fool them. So stay patient and stay consistent when it comes to the 800 credit score habits we talked about in this video. And even if you've got a mid to high 700s credit score, that's still going to be plenty good to get approved for some of the best credit cards out there on the market to start earning some points and saving money on travel, which is the fun part of all this stuff. So if you want to learn about how my wife and I have been able to get tens of thousands of dollars in free travel from our own credit card strategy over the past few years, then make sure to go ahead and check out this video over here on the screen next. But as always, thanks so much for watching.